Welcome to Accounting Actuals. We simplify accounting and bring practical insights on the financial tools that every business needs. Hi everyone, welcome back to the channel. Today we're going to break down something essential for understanding the financial health of your business, the balance sheet. Specifically, we're going to talk about what your balance sheet is trying to tell you. Your balance sheet tells a story, and today we're going to decode that story. What is a balance sheet? Your balance sheet is one of the three core financial statements. It provides a snapshot of your company's financial position at a specific point in time. A balance sheet is divided into two main sections: assets and liabilities and equity. Balance sheet equation always holds true. Assets equal liabilities plus equity. On the left side, you'll see assets. Assets represents everything your business owns, like cash, inventory, equipment, accounts receivable. They are divided into two categories. Current assets. These are assets that can be converted into cash or used up within 1 year, such as cash, accounts receivable, and inventory. Essentially, anything that's liquid or short-term in nature. Non-current assets, long-term assets. These are assets with a longer lifespan, usually more than 1 year. Think of things like property, equipment, and intangible assets like patents or goodwill. A healthy business usually has a balance of current and non-current assets. On the left side, you'll see liabilities. These are the debts or obligations your business owes to others, like loans, accounts payable, or accrued expenses. Liabilities are broken down into current liabilities. These are obligations due within the next 12 months. This includes things like short-term loans, unpaid bills, or unearned revenue. Non-current liabilities. These are long-term debts, typically due after more than a year, such as long-term loans, bonds, or deferred tax. If your short-term current liabilities are too high, it might indicate a potential risk for cash flow problems. Long-term liabilities like loans or bonds are common and manageable, as long as your business can meet the repayment schedule. Also, on the right side, you'll see equity. In essence, equity represents what's left over after you subtract liabilities from assets. Equity can include retained earnings, owner's capital contributions, additional paid-in capital, treasury stock. If your equity is shrinking, it could mean you're incurring losses, or you are taking on more debt without increasing assets, which can be a red flag. Key ratios to watch. Want to dig deeper into what your balance sheet is telling you? Here are a few key ratios you should keep an eye on. Working capital. This is a measure of a company's short-term financial health and operational efficiency. Positive working capital means the company can cover its short-term liabilities with its short-term assets. Negative working capital could indicate potential liquidity issues. Quick ratio, acid test ratio. This ratio measures a company's ability to meet its short-term obligations with its most liquid assets, excluding inventory. It's a stricter test of liquidity than the current ratio. A quick ratio of 1 or higher is generally considered healthy. Current ratio measures your ability to cover short-term liabilities with current assets. A ratio over 1 is ideal, meaning you have more assets than liabilities due within the next year. Debt to equity ratio shows the proportion of debt versus equity in your business. A high ratio means you're relying more on borrowed funds, which can increase financial risk. A lower ratio suggests you're using more equity, which is typically safer. Return on equity, ROE. Measures how effectively your business is using its equity to generate profits. The higher the ROE, the better, as it shows strong profitability relative to the investment by the owners. As we wrap up, it's important to remember that your balance sheet is more than just a snapshot of your business at a single point in time. It's a dynamic, ongoing story. Every choice you make, whether it's expanding, taking on debt, or adjusting your pricing strategy, has a ripple effect on your balance sheet. These ratios that we discussed today are interrelated and work together to show you the financial pulse of your company. Think of balance sheet as a living document that reflects how well your business is performing, where you're growing, and where you may need to adjust. By regularly analyzing your balance sheet, you are gauging your current financial health and setting the foundation for future decisions. Tracking them consistently allows you to monitor your company's financial journey over time, ensuring you stay on the right path for long-term success. Thank you so much for watching. For more information on how we can support your financial goals, be sure to check the details in the description below or visit our page.